What if I told you there was multiple ways to access the equity inside of your house to build massive wealth? Would you do it? Because I know I would. If you are debating on tapping into the equity inside of your house, you're in the right place, because in today's video, we will be going over exactly what a HELOC and a home equity loan is, which one is better for you personally, what are the differences between the two loan products, and make sure to stay to the end of the video because we will be going over exactly how you can use these two loan products to build massive wealth. What's up everybody, my name is Evan Phoenix. This channel is all about real estate education and my journey to financial independence through real estate investing. So if that's something that you're interested in, consider going down and subscribing to my channel. Now let's start off by breaking down a HELOC and a home equity loan. A home equity line of credit is a revolving line of credit that you get by accessing the equity inside of your house. Think of a home equity line of credit as a revolving credit card. And typically a home equity line of credit is for 20 years. The first 10 years is paying interest-only payments on the money that you actually use. And then the second 10 years is for the principal and interest. But don't worry, because you can repay back what you use from the revolving line of credit whenever you like. You don't have to wait until the second 10 years to start paying that back. But one thing to note with the home equity line of credit is that it is a variable interest rate. Now what that means, as the market adjusts, so does your interest rate. So if the interest rates start pushing up in the market, then your interest rate as well will move up. So it is very important to know that if you use from your home equity line of credit, there is potentially a chance that the interest rate will rise and you will start paying a higher payment towards the money that you use. Now the variable rate is based off of the prime rate of the market. The prime rate is essentially a benchmark interest rate that is determined by the Federal Reserve. Think of it as a guide for banks in how they determine what interest rate to use when lending out their money. Now a home equity loan is similar. It is a way to access the equity inside of your house and use your home as collateral. It is very similar to a home equity line of credit, but it is very important to know that a home equity loan has a fixed rate. And not only is it a fixed rate, but it is a loan. So you start paying back the bank every single month as soon as they give you the money. And it doesn't matter if you haven't used the money yet from the loan, you still have to pay the bank. Think of a home equity loan very similar to a car loan. You go to the bank, you get pre-approved for a certain amount, they give it to you, and once they give it to you, you start paying on it right away. The only difference is you receive that money and you can use it for a specific use. Just to make sure everyone's on the same page, the equity in your house is pretty much the difference between your home's value and what you owe on the property. From there, the banks will decide what percentage of that equity they will actually give you in form of a loan. As you may already be able to piece together, these two loan products have their differences, and I want to point out a few key differences between the two products. Starting off with the repayment structure. So with a home equity line of credit, you're able to have a revolving line of credit, meaning that you can draw from it, you can use it, repay it back whenever you'd like, and you can continue using it as long as you pay off the previous balance you had on it. Now, if your home equity line of credit lives through its entire life, it should be about 20 years. Now, on the other hand, a home equity loan is paid back over a set amount of time, and it's a fixed payment. Moving on to the interest rate. Now with a home equity line of credit, you have a variable rate, meaning that it adjusts with the prime rate of the market. When you first applied and received the home equity line of credit, you might have been locked in at about a 5%. But over time, as the market adjusts, if the interest rates were to rise, you may be looking at a 7 to 7.5% interest rate now on your HELOC. And you want to be very mindful of that, because if you use your home equity line of credit and you don't account for the adjustments that could be made, you could be put in a very hard situation. Now with a home equity loan, you do not have to worry about that because it is a fixed rate and you pay the same amount every single month. The next difference is the purpose. With a home equity line of credit, you can essentially use it for anything that you want. When you apply for it, you may put down that you're putting that money into your primary house to raise the value, but after receiving it, you can essentially use it for whatever you want. If you want to buy a new car, if you want to go on a vacation, whatever you want to use it for, you can. There are no restrictions on what you can use it for. Now with the home equity loan, the bank typically lends out the money for a specific use. I wouldn't think that you would just go to the bank, ask for a loan with no purpose or intent to use the money for anything, just to get locked into a loan with a new monthly payment. So with a home equity loan, they typically give you the amount that's needed for that specific purchase that you're going to make. Lastly is the credit limit. When the bank gives you a credit limit with a home equity line of credit, you don't have to use the whole amount. You can only use partial if you would like. Meaning if you were to use partial of it, pay it off, then you now have the full amount again. And you do not have to use the full credit limit, which gives you a ton of flexibility. Now with a home equity loan, you are given a credit limit and you start paying immediately on the amount that they give you. So even if you don't use the money or you only use partial of it, you're still going to be paying that full credit limit back to the bank. So what are the best uses when using these two loan products? For a home equity line of credit, it's probably best if you just want a revolving line of credit to where you could use in case of an emergency, if you want to make investments or pay off some debt. Now with a home equity loan, you really want to use this for a specific reason, for a specific purchase. For example, if you have a lot of equity in your house and you want to sell it by taking out a home equity loan to fix up the property and then sell, that would be a good way to use the home equity loan. Now let's go over 3 very quick ways of how you can build wealth using a home equity line of credit or a home equity loan. Now, a very popular use for these two loan products is putting money back into your primary residence. After someone has owned a house for over a certain amount of years and they paid down their loan balance and appreciation has kicked in, they then want to go put money into the house to make it worth even more. And at that point, it gives them a better chance of receiving top dollar for their house when they go to sell it. And a way to pay that back is either to sell your property and then with the proceeds pay back your home equity loan or home equity line of credit, or you could just refinance the property after it's valued for way more and you take out a cash out refi to then pay off that loan that you had taken out. Just remember, you really want to use these as shorter term debt. You don't want to use this as a fixed long-term debt. The second way is to expand your business. Now I'll use a lawn cutting business as an example. Now if a lawn care business wants to go out and purchase more tools and equipment for their business so that they can hire more people and do more lawns, that will eventually raise the value of their business. And with all that revenue coming in, they'll be able to pay off the loan easily. And the last but not least is to purchase rental properties with a home equity line of credit or a home equity loan. Like I alluded to earlier, you want to use this as shorter term debt. So it would be very smart if you use part of the money to put as a down payment on a property and the other portion to put into it to fix it up, raise the value, and have a bank come in, reappraise it, give you a new loan for the property. That way you have the cash to pay off the home equity line of credit or the home equity loan that you used. My wife and I actually purchased a cash flowing rental property with a home equity line of credit. And get this, we were essentially able to purchase that property with $0 out of pocket. So if you want to see that video, I go in depth on it right here.